Hi, I'm Alice.
Hi, I'm Julian.
And we're from InvestaCrowd. Our mission at InvestaCrowd is to unlock real estate investment opportunities.
And this is our weekly wrap-up of all things crowdfunding. We talk about companies, projects, and regulations from around the world with big focus on Asia. This week, an interesting story in the crowdfunding world. A crowdfunding company in Australia called Domacom, which pitches itself as a fractional ownership for real estate model, listed on the ASX this morning after raising close to $7 million. They've seen a dramatic drop in their share price, which kind of mirrors the same situation that happened when one of the Singapore companies listed also on the ASX in Australia. And I think what it really shows is that Silicon Valley doesn't live in Asia as much. Therefore, companies really need to have solid revenue streams. They need to be making money for the investors on the platform, and the markets are nowhere near as aggressive or up for supporting startups as they used to be. So hopefully that comes back, because we like to see good things happening in our space.
Thanks for sharing. And I know that's a very recent announcement, right? This morning. And back to our coverage of the capital stack. We've already talked about senior debt, preferred equity, and this week we're going to talk more about mezzanine debt. The literal meaning of mezzanine is a small floor in between two other floors. So it's really just a fancy way of saying subordinate or junior debt. And in the financing world, that just means that it sits between the senior debt and equity, and it gets paid after all senior debt has been repaid. And because the loan to value ratio is higher than senior debt, the corresponding interest rate is also higher. Usually, mezzanine lenders don't have security interest on the property, but it's secured against the entity that owns the property. I thought maybe you could share with us an InvestaCrowd mezzanine debt deal.
Sure. So we successfully funded a mezzanine debt deal in Brisbane. It was the development of 60 apartments. I think it was 5 train stations to the centre of the CBD. So it was a small development, a good development. In our particular project, investors were part of the investing in the mezzanine debt. It was a registered second mortgage on the property, so it was asset-backed. The first registered mortgage was the bank. So the bank lent $16.5 million to the project. It probably was charging about 5 to 6% interest rate. The mezzanine investors lent $5.2 million to the project, but they were getting paid 17% per annum. So it was a 15-month term. Total returns were about 22%. When we launched the project, there were already 50 sales out of the 60 apartment sales, so all the debt coverage was already in place, and now the project's being built. So a great project for investors, and things are all on track. So that was a good deal.
And I just wanted to clarify, you can get a mortgage or a security interest in a mezz deal property investment. The security that you get is a junior or second mortgage on the property.
Yeah.
So
we like mezz debt. We think it's a good risk-reward return for investors.
And that wraps it up for this week. Thanks for joining us. If you're interested in real estate investing, please join us at InvestaCrowd.com.
Thanks for watching. See you next week.